as you say, I mean, what we're looking for is that that undervalued earnings upgrade cycle. And really, I think we've all heard the expression, sort of earnings drive share prices. And in our view, it's not really earnings per se. It's not even earnings growth. It's that surprise in earnings, where earnings are not only higher than the market expects, but also persist for longer. And that really is the lens we look at it, and we're looking for quality companies within that. And really, in terms of the way we position, and it's a very stock-specific view, we tend not to take that top-down thematic perspective. And the way we position is we've got our sort of favorite growth names. These are exceptionally high-quality businesses that are compounding growth in a very persistent way, and we think we'll continue to do that and surprise positively on that. And the one I'd call out there, we have many of the technology names that you'd recognize. I mean, Microsoft would be one name that I'd call out. But the one I want to talk to today about is a recent addition to the fund. It's called Universal Music. So obviously, one of the world's, if not the leading music publisher in the world. It recently got spun out of Vivendi, so it's sort of a relatively new listing. The core of the business is obviously that streaming, selling their catalog through to Spotify. That business is a phenomenal business. It's a subscription business growing at sort of high single digits. But at the same time, you've got this amazing new opportunity in terms of these alternative media platforms, so the TikToks of the world, the YouTubes, et cetera, which is just a huge new monetization opportunity for a lot of these music publishers. And we sort of see that. I mean, currently they earn about 400 million euro from these sources. We think that could grow to as much as 4 billion over the next up to sort of 2030, sort of in the context of a business where total revenues are about 9 billion. So that's really phenomenal growth. We also think there's margin upside. This is a business that's very under leveraged. It's sort of got almost no debt. It's sort of 1 times debt to equity. So we think there's a buyback angle there. And I think the sort of icing on the cake, so to speak, is it trades at a 20% discount to the biggest or the closest competitor, which is Warner Music in the US. So this is a company that we think is almost a must-own for growth investors in Europe, and I think is still relatively undiscovered. So it's a recent addition that we feel quite excited about. I think we'd all sort of recognize you had this just phenomenal rally in risk assets across the world, and it's pretty much every asset class, every geography. It's sort of the rally of everything, and you got to the point now where everything certainly doesn't look cheap, and it's obviously been driven by this extraordinary level of monetary stimulus. But if you look forward, I think the areas of caution for us would be that we think growth is probably as good as it gets, and to be clear, we're not calling a downturn or a recession. It's just we're looking at that marginal, the delta. We don't think growth or global growth is going to accelerate from this point. If anything, it's going to marginally decelerate into next year and the year after. We also think, obviously, a monetary policy, a big driver of returns in the recent past. That's also clearly peaking at the moment with the news that the Fed is going to start tapering this month. Valuations are close to historic highs. Margins are close to historic highs. So we are not calling the timing of it, but for us, those are signs of caution. The way we look at it at Alphinity is really through an earnings lens. That's the primary way we interpret and look at the macroeconomic data. And we've got an internal database of 5,000 companies, which we look at and look at the corporate earnings on a weekly basis. And one of the signs that we look at is where the leadership is on a sector basis. And what we're looking for is signs that leadership is changing from cyclicals back to defensives. And I think the short answer is the moment that is not happening yet. There's perhaps some broadening out, but the cyclical sectors are still by and large leading. So if you look at the leadership through the recent earnings season in the US, energy, financials, materials, industrials are still somewhat leading, and the sort of more defensive sectors like staples are lagging. And that's probably one sign. The other sign is just credit spreads. I was a financial analyst for many years, worked as a financial portfolio manager through the financial crisis in London, and sort of been schooled in the importance of credit spreads. And again, at the moment, there's no sort of warning sign per se, but except to the extent that spreads are certainly tighter than they were pre-COVID, and almost in some cases approaching sort of GFC levels. So again, we'd sort of characterise this as good as it gets. It might continue for longer, but I think we are certainly cautious, and I think the way we interpreting that is starting to sort of pare back on some of the more expensive stocks which have run really hard, and just looking for those sort of pockets of value where we can find them on a stock-specific basis. Clearly something top of mind for us in terms of selecting the stocks that we have, and I think there's some industries that just got a historic track record of coping with inflation well, and then there's obviously companies that clearly have pricing power. So maybe in consumer staples, for example, food manufacturers generally speaking have a poor history of passing on inflation. This is something that they really battle with, and I think probably if I had to call out one reason, it's I guess the impact of private label and really the ability to sort of pass on prices at the supermarkets. It's generally speaking not been something they've been able to do in food inflation, logistics, etc., etc. So many of those food manufacturers we are cautious about, and we're seeing that in our earnings data. On the flip side, I think any company with very high margins, sort of more on the luxury end of things, that have got that pricing power. So for example, L'Oreal and Estee Lauder, premium skincare, fragrances. This is sort of affordable luxury, so to speak. That typically has pricing power, has the margins to cope with it. Also, a Nestle, for example, within food manufacturers is better placed. I mean, they obviously have Nespresso, a big coffee business, which is highly growing. That their ability to pass on prices there, premium pet care, nutrition and healthcare. That they, even within that, there are some companies that are better positioned. But yeah, clearly this is something top of mind that we are focused on.